All right, another week of personal finance. So we're up to week three. Things are moving along. Winter's starting to roll in, unfortunately. And here we go. We'll talk about taxes tonight. There's a lot that can be done with taxes. It's obviously, a big part of financial health is earning money, but being able to hold on to it, especially, you know, given the complexity of the tax code and everything else. It's, as I've mentioned before, I mean, I don't want to editorialize here, but the tax code is unnecessarily complex, and you need to be able to figure it out. Unfortunately, it's a complete waste of effort. I mean, it would be so much better if there was a simpler system, but there's people who make money from the system, and then there's loopholes and stuff like that. Loopholes are kind of a joke. They're everything that's in there is intentional, and there's some constituent, somebody somewhere who's taking advantage of it, and one person's loophole is another person's tax break or incentive. So it's kind of sad. But anyway, enough. We'll get into regular taxes. So yeah, they are part of the economy, huge part. I mean, depending, especially where you live. I mean, some places it can be 63% of your income, and there used to be, and then may come back at some point. But for the ultra wealthy, 90% above a certain tax bracket. We'll explain tax brackets later, but again, if you do that, you can have a millionaire's tax and all that stuff, but every time they're implemented, they realize, yeah, it's one thing to have a 90% tax, it's another thing to collect it, because the wealthy, if somebody's in the 90% bracket, back in the day, the 70s, or actually maybe it's the 50s even, and it was, $300,000-$400,000 a year you were making, or more, and back then that was even more money. But anyway, those people have the ability to move. Those people have the ability to hire lawyers. Those people have the ability to never pay your stupid tax. So anyway, it's just kind of it's a big measure that comes up during elections, but yeah, in reality, it's not productive. Paid on earned income, so the money that shows up in your paycheck, sales tax, wealth transfers, sometimes with inheritance, and capital assets. If you're generating money, making money, you're going to pay tax on that as well. And then these things are lumped into what they call sin taxes. Gasoline, maybe not so much of a sin tax, but anyway, alcohol and cigarettes, it's really tough to say, well, that tax is too high on cigarettes or alcohol, because people come after you saying that, oh, that's, you want to discourage that. It's bad for society, so we should be able to tax it. But the truth is that if these taxes go away, there's a lot of things in society that kind of fail. And there are, especially in the cigarette tax, some forms of government are so reliant on those taxes that they're in a bind if people did quit smoking. Corporations pay taxes on profits, which is, it kind of amounts to double taxation, because corporations are owned by people, right? So people get personal income tax, and then corporations pay tax again. And so when you look at different forms of business, that's one of the downsides of corporations, is that as a corporate entity, if you choose that over a sole proprietorship or a partnership, anyway, there's tax implications. And one of the tax implications for a corporation is that it actually pays its own tax, and then it distributes dividends or profits out to people, and then they pay tax on that again. Homeowners pay property taxes. Yep, supposed to go towards schools and other goods, and a lot of things are necessary, but anyway, there's some things that reasonable people might agree are maybe a bit extravagant or not allocated properly. And now, with the debt the way it is, a lot of the taxes just go to pay the interest on the debt, which is, doesn't make it to any specific program or help anybody out. Used to pay for government services and programs, and also the debt. Most individuals pay federal, state, and local. So in Alaska, obviously, we know it's a little bit less of a state tax. Corporations pay taxes in Alaska. Actually, it's one of the higher rates, but there's no personal income tax. And obviously the PFD is actually kind of a negative tax, so that's all good. Local level, if you're in the municipality of Anchorage, obviously your property tax is pretty high. And if you're in the valley, you're going to pay a little bit on sales tax. And I guess also in Anchorage, you're going to pay more of a sin tax again on alcohol and some arbitrary kind of things. Down in the Kenai, I believe they have some property or sales taxes as well. So anyway, federal tax system administered by the IRS. So where are they paid? Time of transaction, through withholding, and then making quarterly payments. Sometimes if you're actually somebody who's going to be paying taxes, and let's say you have a big tax bill this next year, you will probably it's normally you pay your tax on April 15th, but if you owe them money, they being the federal government, then they believe that they're due that money throughout the course of the year, so they'll have you make quarterly payments, which is again unfortunate. Social Security, Medicare taxes. So Social Security, we'll talk about that in great detail, but that's taxed and it all goes to you. Yeah, nah. It actually goes into a fund, and that fund gets rated. So Social Security is, I sound like just complete doom and gloom here, but the tax system is a mess. Medicare, those taxes are taken out as well. So you all know, when you get your paycheck, you're like, this is great. I'm getting whatever per hour, whatever per year, and then your take-home pay is somewhat less. So we've got Medicare. So Medicare is for older folks. Medicaid is like a form of welfare. That's a different type of tax. It's not tax, but a benefit. So Social Security, Medicare taxes, both you and your employer pay this. So up to a certain level, this level has changed a little bit, but you can say if you're making, whatever, 130, 140, your Social Security tax will actually stop. And this can become a situation, especially like in a gig kind of economy, where you've got maybe a couple jobs and maybe both of them are substantial, and say they're both paying whatever 70 or 80,000 or some combination that puts you above this limit. Your individual employers may not know, and they're going to go ahead and withdraw or withhold that higher amount. Medicare 1.45, and then self-employed people must pay the taxes themselves. So personal income taxes. So they're going to talk a lot about forms and other things in here. We're not really going to specifically address forms. I'll show you some. They're in the book. They talk about them and all that. But most of the time, your taxes are going to be done one of a couple different ways. You can do them yourself, which you're probably going to use, some sort of computer assisted, some sort of software kind of stuff. And so you're not really going to see these forms. It's not going to say, now we're going to start in your 1040. It will ask you a bunch of questions, and we'll go through TurboTax a little bit, just kind of an introduction to that. And they won't be referencing specific forms. But after the whole process is completed, now that it's gathered all that information, it will go ahead and spit out these forms for you. But this 1040EZ, maybe you're filling that out right now, but once you have any sort of financial resources, this will not apply. You're going to be up in the 1040 because you want to have deductions. Otherwise, you're going to be paying more in taxes. So we'll talk a little about deductions, itemized deductions, and the rest of that. Normally April 15th. So with COVID, obviously that changes around a bit, but we're back to April 15th. The deal with this, though, is you're always paying taxes in arrears. Right now, we're in the year 2023, and so April 15th of 2024, you'll be paying taxes back to 2023. 2023. The the other aspect of this is that since the taxes are done by the calendar year, as of December 31st, any financial transactions or actions you take, by the time you get around to calculating your taxes, it's too late. That ship has sailed. You can't change the situation. You can't say, "Oh, I wish I wouldn't have done that last year on my taxes." All that stuff's frozen in time. Now, you can sometimes contribute to a individual retirement account up until the tax day, but selling houses or doing any of that kind of stuff and have it impact your previous year's taxes, no, that's done. I don't know why I had this in here, just to show you that, yeah, completely fuzzy slide. It's even fuzzy on this. That about half of the taxes collected come through income taxes. Then some corporate taxes, payroll taxes, excise tax, other taxes. So, you have two different types of tax systems. You have a progressive system and a regressive system. A progressive system taxes people who earn more money. They pay a higher tax load, not only in absolute dollars, but also in the percentage of their income that's taxed. So when we talk about tax brackets, the more money you make, the higher percentage of those, tax brackets you pay. And then you have regressive taxes. An example of a regressive tax would be, let's say the police department, not to use Anchorage as an example, but anyway, let's say they want to fund their police department by writing copious amounts of traffic tickets. That's a regressive tax, because if I'm making $1 million a year and I'm, driving down the Glen at whatever, some ludicrous speed, like maybe 68 miles an hour or something, and I get a ticket, whatever, maybe $100 or something. The person who's a millionaire, that doesn't really, that's not that big a deal. $100 in the big scheme of thing, when you're a millionaire, is making $1 million a year. That's not a big deal. Somebody who's just, trying to get to their minimum wage job and they're hit with a $100 ticket, that is a big deal. So that is a regressive tax. So the income tax is set up to be progressive, but all these sin taxes and other things, and it can be argued also that, people who smoke generally are maybe in the lower areas in terms of income, and they're hit with the taxes to do that. But anyway, that's behavior they choose to engage in. But so the notion of progressive and regressive taxes, and in concept, the system is set up to be progressive. Now, again, the people who are making the most money also have the best lawyers and have the best accountants and can do things to favor their taxes, so maybe they're paying a little bit less. Rise and fall of minimum wage. You always get into this, people talk about current minimum wage. This is getting dated now, obviously. I wasn't able to get some of the new data, but people think, if we were getting paid $15 an hour, it'd be great. Yeah, minimum wage is so far behind, and again, we can get into an argument whether it's a training wage or a living wage, but $15 is not a living wage these days. And so if you want to argue that minimum wage should be $15, it's probably a more valid argument to say it should be quite a bit more. Filing status. When we get into filing taxes, the goal in filing taxes and completing your taxes is, believe me, you're going to pay enough tax. What you want to do is you don't want to evade taxes. Evade is cheating. It's, lying, not paying. But avoiding taxes is that's how the game is played. That is what you're expected to do. That is what the tax code is written for you. The tax code, if you, are a good little rat and you follow and get your government cheese at the end of the maze by going through a bunch of wickets, a bunch of things on the maze, then you've been a good citizen here. They want, there's many things in the tax code that you'll get either tax deductible or tax credits for what society, what the government considers good behavior. Good behavior would be things like maybe adopting a child. All those expenses are normally, that can get kind of pricey, and that can maybe defray the cost by having tax credits and tax deductible areas. We'll talk about the difference between deductible and credit later. But anyway, having a home, that brings stability to the nation, stability to society. So you want to encourage home ownership. So if you do own a home, there's benefits associated with that. Giving it charity, charitable deductions are tax deductible. So investing in businesses, there's a lot of those things are they're tax advantaged. But anyway, most of the things, solar panels and whatever energy efficient cars or home repairs, many times will be home repairs that result in a great decrease in energy usage. Oftentimes are tax deductible or tax credits depending on the program. So on this page, though, we're talking single, married, married filing separately, and head of household, and then a widower. So single is going to be paying pretty much the highest tax, as an individual there. You don't have any dependents, and it's considered fair that you pay a little bit more than somebody who's raising children or has a family. So married filing jointly, this is when obviously two people are together, and their incomes are many times balanced out. Now there's an option here for married filing separately, and this is one of those things that it helps to have a program like TurboTax or a smart CPA or somebody who can go, what should I do here? And on a thing like TurboTax, you would run the numbers both ways, and a lot of times it can be advantageous to file separately if, say, one person, one of the couple is making a great deal more money than the other. But you have to look and see what the situation is. There may be some benefits, some government benefits that you're entitled to as a low income person that might go away if you file jointly. So again, people might file separately. The default is typically to file jointly. Typically that results in the least amount of taxes, but everybody's situation is different, so it's nice to be able to run them both ways and see what works out. Head of household, that's just a situation when you are somebody who's single, but there's somebody dependent upon you. And a dependent can be a child, or it can actually be some sort of adult in a different situation, or an elder or something like that. You have to look at the code to see what qualifies. But typically it's obviously there's having a child with a single parent is not that unusual, and the IRS treats that person with kind of the benefits of somebody being married. Qualified widower with a dependent child, so just because your spouse passed away, they throw you a bone there. They help you out a little bit. There's a 1040 form. Pretty daunting stuff. I mean, you can just nug through it and get it all done, but the time that you're spending on taxes is far better spent on how to minimize your tax bite, how to do this as best as possible, and filling out the forms is just, that's not really a productive use of your time. If you can do that via software, that's probably quite a bit more efficient. And then again, as I mentioned on the software, all this information that didn't change from the previous years, it's just auto-filled in for you, and the only action you have to do is edit it if there's any differences, but otherwise it kind of comes out half pre-filled out for you. They're going to talk about all the different stuff, but yeah, basically you're going to come in with how much money you made, and then interest, which is also income, other types, dividends, that's investment stuff, alimony, that's why people generally perceive inflated child support rather than alimony because child support's not taxable. Anyway, capital gains, that means, you bought something for less than you sold it for. IRA distributions treated like income. Pensions, annuities, so all this income stuff. And then you get down in here to AGI and all the rest of it. You don't need to take this all in right now, but when they're asking you questions, either the person preparing your taxes or the software you're using, or if you want to do it yourself on the paper forms, that's the way it's going to work. Taxable income, earned income. Anyway, it's going to tell you how much you paid. And then you're going to also look at how much was withheld. You're going to enter in your W-2s and show how much income has been withheld. What your withholdings were throughout the year. And if the withholdings are done correctly, it should be almost a wash. It should be the amount withheld is going to cover the tax. Fallacy, you can tell if somebody really doesn't know what they're doing with taxes when they say, I got a huge refund, this is great. No, you gave the government a huge overpayment all year long and then they gave it back to you. You would have been better off by having your withholdings matched what was actually going to be paid on your taxes. The government doesn't care. If you want to, have them withhold a tremendous amount of money and then get a free loan all year long, there's not going to be any complaining. But if you under withhold, now the government's going to say, wait a minute, because they do know the time value of money. And they're going to say, you owe us interest and penalties because you under withheld. So, gross income, gross income, all the different sources, wages, salaries, interest, gambling winnings. If you want to get down to the weeds, you sold a vehicle. I mean, people don't typically report this, but if you sold a vehicle for more than you paid for it, they consider that something that's a capital gain. Has it been, remember, short-term, long-term, under a year, over a year, dividends, paid on stocks and stuff. We'll talk more about that in investments section. Capital gains tax. Now again, some of these taxes, like I said on real estate, it is favored under the tax system. So if you have huge capital gains in stocks, you got to pay the tax. If you have huge capital gains in real estate, sometimes you don't need to. If it's a home that you lived in 3 out of the past 5 years, and then there's again limits on that, but say it's under, I think, $200,000 or $400,000 in capital gains, you don't have to pay tax on it. So there's all sorts of little benefits that are written into the code that make home ownership more attractive. And some of that's obviously because they deem that good in society, or some of that's because the real estate lobby is quite strong. But anyway, there's nothing really in the tax code by accident. There's usually some push person or constituency pushing for taxes. So the gross income is the big number, right? And then here's the dividends. Yep. So dividends. Don't get too wrapped up with dividends. What that means is, say a company, they sell stock, they make money. The company makes a profit. They can do two things with that money. They can reinvest it in the company, build more stuff, which most growth companies would be doing, or maybe they're a big mature company and they'll return those dividends to the shareholders, return the profits to the shareholders by way of a dividend. So anyway, you're going to get taxed on it. Schedule D, capital gains. Yep. Most of these items are caught on, different forms. You get all these forms at the end of the year telling you it's a 1099 DIV, a 1099 INT, or just the stock ones will be another form for that, and it will tell you what your gains and losses are. And they send you a form, but guess what? They also send one to the IRS. So the IRS knows what's going on. And since the IRS records are typically automated and yours are just showing up randomly in the mail, a lot of times you get in trouble with the IRS because they tend to get all their paperwork in order, and you may miss something. Again, just kind of marching through some of the forms that you may or may not see. So, but again, the gross income is everything. Standard deduction. So, one of the things that's in there is the standard deduction. So, it's probably easier to start out from a perspective of itemized deductions. Let's say, you've got expenses related to your job, or other taxes paid, or things like that. Those items, you would itemize them. You would add up all those little small things, and generally, the small things become larger. Well, what the government has decided, the IRS has decided, is if you really don't want to bother adding up all those little numbers, or you don't have that many deductions, you can just take the standard deduction. And let's say the standard deduction is just for whatever. Let's say standard deduction is like $18,000 worth of deductions. You can say, there's no way I've got that many, expenses. I'm just going to take the standard deduction. So filing your taxes is quite simple. You can use one of those easier forms because you don't have to itemize. But let's say you're a homeowner. Well, as a homeowner, you can deduct the property taxes paid, you can deduct the mortgage interest paid, and then you can get into all these other, smaller things like business expenses and other stuff, and your amount of deductions, your itemized deductions, greatly exceeds the standard deduction. So you would not take the standard deduction. You would itemize and take that larger deduction. It only makes sense. So many things are deductible, can come off your taxes, but you have to kind of know the rules or use software that's got the rules built into it. For example, let's say like medical expenses. Let's say you have medical expenses that are unreimbursed, so you didn't get, the insurance company didn't pay for them, but you have all these expenses that are, out of pocket. Can you deduct those? It depends. They have to exceed a certain limit, and typically that limit is, I believe, it's 10% of your income, which could be a lot of money. If you're making $100,000, you had over $10,000 in medical expenses, so that were unreimbursed. So you were probably pretty sick. Or, obviously medical expenses, it probably doesn't take a whole lot to get about $10,000. But anyway, medical expenses may or may not be the best option. So these are kind of older numbers, 2015. That's why I'm saying like 18,000. But anyway, you add up all those little small deductions. But if you own a house, you're pretty much going to exceed this. And you're going to end up paying less taxes because the deduction comes away from your gross income and results in an AGI, adjusted gross income. So you pay your taxes on your adjusted gross income. So you got gross income, you take away your deductions, and then you end up with AGI, adjusted gross income. So itemized deductions, yep. Interest expense, primarily on mortgages, yep. Credit card interest, not tax deductible. That changed now. It's probably been 15, 20 years, but that was a big deal. And it made the decision to carry credit cards just a no-brainer because the interest is no longer tax deductible. This is kind of a red state, blue state thing. State income tax may be deductible. Well, obviously, if you're in a high-tax state like California or New York or something, those state income taxes are huge, whereas somebody in Alaska, you don't have that deduction because you didn't pay those taxes, which is a good thing. But it means that you're making $100,000 in California and $100,000 in Alaska. The person from Alaska is paying more into the federal system because they didn't pay money into their state system. And it also makes the states, the high tax states, a little less responsible, you might say, because they know that their taxpayers are not necessarily going to pay more taxes overall. They're going to pay more taxes to the state and less tax to the federal government. So it definitely becomes a red-blue state thing. It's called SALT, state and local taxes. And one of the things, like Trump, for example, he said no. He said those are no longer tax deductible. So just from a going-in argument, you can tell that Trump would not be a popular person in some of those high-tax states, and would be more popular in low-tax states. Real estate tax, yep. So again, varies greatly. And again, relative, especially in Alaska, I don't know the other boroughs, but the difference between the valley and the municipality of Anchorage is pretty significant. So the medical expenses, like I said, in excess of 10%. I would not wish that on anybody. You're having some issues if you're able to deduct that are completely unreimbursed. No insurance on that. Charitable gifts, yep, tax deductible. Other expenses, so thefts, losses, jobs expenses. So, yeah, I mean, I've done this before where I've had, some vehicle that wasn't really worth insuring and it got totaled out. Well, I wrote it off on my taxes. I don't get all the money back, but I get a portion of it. So I guess I got to talk about that right now. So tax deductible versus tax credit. Let's say you owe, whatever, $30,000 in taxes is your yearly tax bite. You're making $100,000, so you're paying 30%, which is pretty high even by today's numbers if you know how brackets work. But anyway, let's say your tax load to the federal government is $30,000. If you get $1,000 tax credit, the taxes you would owe would go down by $1,000. It's a one-to-one thing. It's a credit. So you would owe $29,000. So it's a savings. If it's a tax deductible thing, so they're trying to get you to give to charity or do this, do that. Oh, it's tax deductible. Yeah, you want to do it. So let's say you donate $1,000 to a charity. How much did your tax bill go down? How much money you're actually giving to charity, and how much is your tax bill being lessened? Well, if I said this notional 30% tax bracket, you, by giving $1,000 to this charity, your income would go down. Let's say again you're making $100,000. You were making $100,000 a year. You gave $1,000 to charity. So now, since it's tax deductible, you would claim that your income is only $99,000. And since your income's only $99,000, that's all you're paying taxes on. Well, if you're in the 30% tax bracket, for every $1,000 you make, you're paying $300 in taxes. So you gave $1,000 to the charity. In reality, it cost you $700 because you were able to give them the full $1,000 amount, but your tax due went down by $300. So, obviously, if you're given a credit or the option between a credit or tax deduction, the credit is the one you want. In reality, most things are tax deductible. 1040, again, they're just going to roll back through this. But anyway, you can see some of these things that are coming up. Unreimbursed employee expenses. Yeah, I mean, if you're in a certain line of work, let's say, military, and you have to have your hair cut, and you want to be fairly, anal about this, yeah, you can say, okay, it's costing me, $23, and I'm doing this every 2 weeks to, keep in. Well, $23 adds up over the course of a year, so you could, perhaps keep the receipts or keep some sort of record and claim on your taxes that was a work related expense that wasn't reimbursed. Now, if the military is giving you uniforms or giving you a uniform allowance, you can't deduct the clothing. But if you're, there's certain things with teachers, for example. Maybe there's things in the classroom that are necessary that are not provided by the school. And so you want it to, you're going to be pulling money out of pocket to provide those things. Check the rules, but a lot of times you'll find those things within limits are tax deductible. TurboTax, we'll go take a look at it in a second. I sound like a whole TurboTax fanboy, but it's just like everything else. I mean, TurboTax right now is probably pretty good. Maybe by next year, they'll get sloppy and greedy and their program will be worse and there'll be somebody else emerge out there. There's probably already some competitors out there that are trying to get market share that may offer better deals and all that. So I'm not, trying to promote one specific company. But what I will say is the software programs are pretty efficient, and find one that works for you. But again, you need to keep evaluating it year after year because TurboTax almost has a monopoly right now, and so that's never good. Their service is probably gonna get a little sloppy here in a while. Exemptions. So this has to do with, say, children or dependent people who might be in an elder type situation or somebody who needs a caregiver. You have to look at the rules. For most people, exemptions are natural children, but there can be other exemptions. Taxable income and calculating taxes. So again, there's a table out there when it says, okay, your adjusted gross income is so much. You had your gross income, you subtracted out your deductions, you claimed your number of exemptions, and then you go to this table and it says, okay, your tax is this much. And there you go. Here they're talking about progressive tax. So we talked about this before. A tax system where positive relationship between an individual's income, so meaning that positive, that the tax rate goes up. There's a really good explanation of tax brackets in a video that I'll show you tonight. So again, it's not only great evaluation of tax brackets, but it's a great tool to use when somebody's giving you tax advice. Ask them about tax brackets because it's the most misunderstood. It's very simple, but it's also completely misunderstood. And so you can very quickly sort out somebody whose advice is not worth listening to by asking them specific questions regarding tax brackets. You'll hear people say, "Oh, I don't want to make any more money because that's going to push me into a different tax bracket," which means that they fundamentally don't understand tax brackets. The way tax brackets work is, let's say you're, again, going back to the simplified example, let's say the tax bracket for under 100,000 is 20%. The tax bracket for over 100,000 is 30%. In reality, there's all different brackets. They go up at all different incomes. There's multiple steps. But in this simplified example, what that means is that all taxes under 100,000 would be taxed at 20%. But let's say you made $100,005. 100,000, all zeros out there with a 5 at the end. Now you're in the 30% tax bracket. What does that mean? All that means is that final $5, just that $5, everything else is taxed at the lower 20% or whatever rate. But that final $5 that exceeded the 100,000, that little bit is taxed at 30%. So again, when going back to this tax on millionaires, let's say you say everybody making $400,000 a year or $500,000 a year needs to pay a 90% tax on every dime they make above $500,000. What are you going to find? Nobody's going to make over $500,000 because why would you? It's all but 10% of it's going to go to the government. So if your incentive in working, and which is true for most people, is to earn money, you're not really earning much money at when you only get to keep 10% of it. So it's wealth taxes are there's if you want to get into this, tax brackets, tax rates, what works, what doesn't. There's a man he shouldn't be controversial, but he is. His name's Art Laffer, and there's a thing called the Laffer curve, and what that means is that his it's not rocket science. It's fairly common sense that there's a sweet spot out there where if you tax people at say 15%, they're going to work as hard as they possibly can because 15% is not that significant of tax. Now, if you tax people at 50%, oof, that's fairly significant. You're going to find some people spending more time, evading the tax. You're going to find them not working as hard as they normally would because, they're like, why should I? I'm going to lose 50% of it. So if you look at these two extremes, 15 on the bottom and 50 on the top, and granted, these numbers get even more extreme in some of the examples you see. There's a number that say maybe around 25 that's not going to discourage people from working, yet is going to result in more money to the government since they're taking a higher percentage. That's going to work. The way you need to think about taxes in the economy is like a like a full pizza, a big, and let's say you cut this pizza into eight slices regardless of the size of the pizza. So as the pizza gets bigger, those slices get huge. The slices, they're still, geometrically, they're still the same angles, but since the pizza, the diameter got so big, that individual piece is just mammoth. And that's what a lot of times you'll hear people talk about, well, they lowered taxes, yet the revenue to the government went up, greatly. That's because the economy grew greatly. If the economy's big, the government could get by with taking just 15% because it's such a big pizza. But again, if the economy's, in recession, not doing well, and the government takes, 30% and ends up with less money, that's because, or 30%, 50%, and ends up with less money, that's because even though the government's taking a huge percentage, the overall economy they're taking it from is quite small. So anyway, if you are interested in that, you look at this guy Laffer, and again, the reason I say he's controversial is because he was a Reagan guy, and that may put a lot of you off right from there, but I think it's fairly hard to disagree with some of his statements. But anyway, so here's some brackets. This was for 2021, and this will be explained better in the video because it just works out better in the secondary video. So this is where we talk about a progressive system. So here's somebody, this is a single person, right? And they're only clearing per year less than 10 grand. So should we beat those people up very much? And here, this is married and here's head of household. So no, the person's barely getting by. So in reality, they're going to get some benefits back and probably get more money back than they actually paid in. But on their actual tax, when they're filling out the 1040 and stuff, they're not exceeding 10 grand. So they're only going to get charged 10%. Now here, they're doing slightly better, up to 40 grand. So that initial 99.5, 50 is only charged at 10%, but that interval, every dollar above this amount, up to 40,525, is taxed at 12%. Again, not a super high rate. Now 40 to 86, this person's, they're doing all right if they're living within their means. They're going to get taxed at 22% for this interval. Just not their whole income. It doesn't go back and start taxing. No, their first, nearly 10 grand was only taxed at 10%. And here's the next one. 24% is the 86 up to 164,000. So you can see that's probably going to capture a lot of people in that, But these again, this is still with the Trump tax break. These numbers may go up. So, again, a max tax of 37% for somebody making $500,000 a year. That's probably not providing a disincentive. That person, if they're crushing it, if they're making $500,000 a year, they may go ahead and try and make even more, knowing that they're going to keep that other 63%. So that's probably pro-growth. Anyway, you can discuss that, but that's how the taxes work. Capital gains. So this is income tax, right? Capital gains has to do with like investment taxes. And these are long-term capital gains. Short-term capital gains are treated like this other example. They're treated as earned income or regular income tax. So that's why if you're making some money in the market and you've had the stock like 9 months and you want to sell today, well, yeah, it's kind of a gut check. Is the stock price going to hold? If you think it's going to hold, if you could stretch it out to a year, your tax hit is probably going to go. Let's say you're this higher bracket because it's exceeding your income or 24%, whatever. You're going to pay a lot less tax on it if you kept it a year long term. So 366 days, you're paying the lower rate. Anything less, if you're some day trader, you're always going to be paying the higher rate. Determine your tax liability. So tax on the base, percentage, yeah. Anyway, they go to on the schedule. It's just a table that tells, okay, with this AGI, you owe us this much money. We talked about credits. So again, positive things. And for credits, it's got to be fairly positive. They're not just handing out tax credits. Here you have a child, you're procreating, you're keeping civilization going. Good on you. There you go. College expenses, tax credit for, but there's income limits on that, which you might find out. Coverdale savings account. So there's a lot of things where you're taxed on capital gains, you're taxed on your investments, but if those investments are specifically earmarked, specifically allocated to education, and they're used for that purpose, when you withdraw that money out, they can escape taxes. That's a good thing. Earned income tax credit. So again, when I said people may get money back who don't even pay in, that's how that works. And tax credits for child care, adoptions. Obviously, that's a good thing. So, when they talk about, that's a tax loophole, no, there are some, but for the most part, they're trying to motivate you into behavior that they want you to perform. And financial planning, TurboTax. So, and then some homework, problems 5 and 9. So we're going to try this real quick. This TurboTax always kills me here because they log you out. I use TurboTax for certain things, but this is just a bogus TurboTax account. This under my college, whatever, university one. They just made me change the password. But this is all just bogus numbers. You don't have to give them your good information if you're not going to file with them. And you don't pay until you actually file. So if you want to run a couple different examples and see how things work out, they think my name's Jay. Obviously, they don't have all the info. But, I'm not going to put it in here because this is just for, use. I was born in 81, maybe not. quad nines on my or 699 whatever. Single, yeah, I live somewhere in Palmer. They think whatever. But anyway, I just want enough data in here to make the numbers work out. Now they're going to try and upsell me on a bunch of stuff. We'll see if we can get through here. Okay, so keep it very simple. My job D here, I'm just making 100 grand a year. Perfect. I'm not showing any investments. But what I want to show you is just some of the things you can do with this. I've already entered in the income and all that stuff would stay within the program. Again, another upsell. Nope. I mean, maybe you want to take advantage of some of that stuff. Foreign bank account, not as bad. I do have foreign bank accounts, but you have to have more than 10 grand in them, which I specifically never do. Okay, so now it's going to start asking you questions. And as if you answer yes to this, it's going to generate a form. Do you care the number of the form? No, I'll probably review it later on, but it's going to ask you all these leading questions, which are good to make sure that you don't miss items. So again, even if you don't file your taxes through this system, it's not a bad check on either yourself if you did it on paper, or the person you have preparing taxes, or just some of the what if type things, because you can be working on obviously next year's taxes at this time. So the other thing that's kind of cool with this program is see how it's got the refund posted up here in the corner. So I think I already used these examples. Okay, it's going to force me to answer some of these questions, but I'm going to get in here to some of these deductions and credits. Okay, just going to jump ahead. So the reason why I've got a big whopping refund up here is because I'm shown that I'm a big homeowner, right? I paid 18 grand in interest. That's not that unusual. If you just bought a home, and we'll talk about this in the real estate section, most of your payments for the first portion of the loans on a 30-year mortgage, most of that is interest, very little principal, meaning that you're not really paying off your note, you're paying the interest on the note. That's just the way mortgages are structured. And here, I'm showing that probably live in municipality of Anchorage. I'm paying 9 grand in property tax. And then also I'm a good person. I gave $5,000 to charity. So my numbers got positive all of a sudden. Let's say I live in an apartment or I rent a house. Well, the owner of the house, he's going to get to deduct this stuff, but not me. So I'm going to not get this deduction. So the 18 grand goes away. Real estate taxes, no, he paid them. I didn't pay him directly, so again, I don't get credit for that. So we're looking at 9,400, and because I did that, so I don't get it all back, but I do get a portion, and that was about what, 4 grand more or less in that change. Now, one other thing I want to show you, and you can sit here and literally you can create an account and jump around in here, do whatever you want, just to kind of explore things. I'm going to go back to deductions and credits again, and I'm going to show my donations to charity. So, this is I probably shouldn't have made it 5,000. Let's make it, I'm going to edit this down, and I'm going to make it a $1,000 thing. So it's making sure it's a tax year. What did you donate? How'd you value it? Furniture, 5 grand. Yeah, maybe I exaggerate a little bit on that. The IRS may go, wait a minute, it's really worth 5 grand at a thrift store. It's like you donated a whole house. You might find yourself in examination if you did that. Okay. Purchase price, whatever, $2,000. Lost half of its value. I'm just going to put various. Okay, boom. Yes. Done. Okay, so I'm just trying to establish a new baseline. Okay, so we're going to go back. It wants an address. Again, it doesn't really matter. Yeah, it can be my home. I don't care. And it's probably not going to like any more about that. Just trying to get through here. It is kind of frustrating. Okay, so let's go back to this donation. So we can see that my refund right now is $52.26. That's based upon giving $1,000 to charity. Let's say, basically Scrooge McDuck here, I give nothing to charity. Boom, I zero this out. So $52.26. Everything else remains the same. This program makes me mad sometimes. Okay, so what it should have done, and there's probably something, it knows the tax code better than I do. There's either it didn't do the calculation yet, but my tax refund should have gone down by $700. So I'll work on that. Maybe I'll have that example for you next week. But anyway, you can manipulate these numbers around, and it will change things. Sometimes you hit a minimum on the amount of tax you've got to pay. I mean, for example, that one example I used about college expenses being tax deductible, I thought they were, but I just happened to exceed the income threshold that particular year, and it made a huge difference. It wasn't a tax bracket question, but it certainly was a tax, whatever. It was a gotcha. And you will hear people say, oh, I don't want to make any more money because then I won't be, eligible for the Affordable Care Act, the Obamacare. Again, some of those things that are in the tax code, not that Obamacare is something that's a great program that you definitely want to be available for, but there may be situations where, again, running a program, knowing what the income limits are on some programs might have huge implications for you. But in terms of absolute income and tax brackets, yeah, again, everything I said about that was completely true. But anyway, you can see that, things in here, and again, they don't have the corner on the market. There's other programs out there, but it's fairly user-friendly. It gives you the calculations, and it's pretty useful in my mind. And again, no money has changed hands until I actually let's see what happens here. I've never used this before. It's for a simple tax program. It's typically under $100. Yeah, $59. There's no state refund. So, yeah, worst case scenario, it's not a whole bunch of money, and it would definitely e-file. So, if you opted to get advice, if you opted for audit protection, if you opted for all those things, then they're going to get some real money. Anyway, till next week, and next week I will figure out that tax deduction problem and get to the bottom.